Okay. Yes, the recording has resumed. So from where we stop, there are 3 ingredients for calculating goodwill, and each ingredient has its way of affecting the consolidated income statement. There are 3 important aspects of the fair value of consideration transferred that will affect the consolidated income statement. We have the deferred consideration, we have the contingent consideration, and we have transfers of acquirers' assets. So that we should be wary of these 3 anytime we are dealing with a consolidated income statement question. And the second ingredient is how NCI is valued, which is either at proportionate value or fair value. And the third one is fair value of net asset at acquisition. We also identified how this will affect the preparation of consolidated income statement. The ones painted in yellow and red are the aspects we need to be careful about. Once you stir up these 3 ingredients, you would arrive at a positive figure or a negative figure. The positive figure is goodwill. It is an asset. So because it's an asset, right here in this block here, you see I stated it that if goodwill, that figure of goodwill has no impact on income statement. However, if you have gain on a bargain purchase, that's what they call negative goodwill, then that will be added to income statement as a separate line. It will be an addition like an income. In some textbooks, you will see them add it to other income. But most times, from what I have seen in practice myself, the gain on a bargain purchase is preferably shown as a separate line in the income statement. If you have goodwill, the question may also want to test impairment loss. That's when goodwill is impaired. Impairment loss as a value, as a number, is an expense. So because it's an expense, it will affect the consolidated income statement as well. So that is why you have these 2 boxes colored in yellow, which depicts how it will affect the consolidated income statement. So don't forget, at acquisition, your goal is to calculate goodwill or gain on a bargain purchase. Once you have calculated it under SFP, you are through with your at acquisition. But under income statement, for each of the ingredients used for calculating goodwill, you are expected to treat them appropriately in the income statement. We now said that once you see the story of at acquisition, the next set of story you'll be seeing is post-acquisition. And from what we learned, post-acquisition can also come in different forms. But we said that a sign that you are now at post-acquisition is when you are seeing intra-group transactions. By the time you check the additional information, you will see intra-group transactions like sale of inventory, sale of PPE, intra-group borrowing, intra-group dividend, and the likes. These are examples of the intra-group transactions that can take place between the parent and the subsidiary. Once you are done with treating intra-group transaction, the next set of item you might need to bug yourself about is investment in associate at this stage. So the next set will be investment in associate. That's the third aspect. And to deal with your investment in associate, this is the calculation, like a format, which is used for calculating the income or loss from associate. And the last thing we are always expected to do in a typical consolidated income statement question is to share the profit or loss for the year and the total comprehensive income between our parent and NCI. Most times we just calculate NCI share, and the parent share is typically a balancing figure. So all these things were most of an introduction to this topic. Today, we'll be looking at how far we can go with solving some questions. And instead of the typical marker board you are used to, we'll be using Microsoft Excel to solve the questions we have to solve. The question booklet has been shared on the group, but be rest assured that I will also project it here so that everyone can see it and our official readers can read directly from the screen. So I will just project the question. But before we start solving the question, my people, do you have any question for me? My people, do you have any question for me?
No from my end.
Okay. No question. So here is the question we'll be looking at, question 2. Who is the official reader in this our class? Please, the person should help us read this question.
Okay, I'll read.
Oh yeah, thank you very much.
Colombo and 80%.
No, question 2.
Colombo is an 80% subsidiary.
Question 2.
Colombo, where you see Colombo?
Okay, question 2.
Yeah. This Cairo I'm seeing.
Okay, okay. Okay, Cairo is an 80% subsidiary of Egypt that was acquired 1 year ago. The following information relates to Cairo at the date of acquisition. Ordinary share capital, 300 million. Reserves, 500 million. Fair value of the net assets, 1,000. Fair value, 250. 1,000.
Yeah, all figures are incorrect. Yeah.
Okay. Statement. Okay. Statement of profit or loss. Revenue, 1,000.
Yeah, all figures are incorrect. I'll project the additional information.
Okay. Okay, additional information. Egypt has sold goods to Cairo for 100 million naira. These goods were sold at a margin of 40%.
We are yes, sir.
It's
the man
back
is back
now.
The man is back. So let's be
Guys should take it easy. It's network issues.
Well, I'm very sorry. That was the country where I found ourselves. Sorry about that. Okay, Madam Kimeze, please, can you continue reading from the first additional information?
I was not the one that was reading.
I was the one reading.
Okay, whoever
it was Okoyemi that was reading.
Okay, Okoyemi, please, from additional information 1.
Okay, during the year, Egypt had sold goods to Cairo for 100 million naira. These goods were sold at a margin of 40%, and 1/2 remains in the inventory at the year end. At the date of acquisition, the fair value of Cairo's net assets were equal to their book value, with the exception of an item of plant, had a remaining useful life of 5 years. Number 3, goodwill is to be calculated using the fair value of the non-controlling interest as at the date of acquisition. An impairment review at the year end reveals that 1/10 of the goodwill that arose on acquisition was impaired during the year. Required, prepare the consolidated statement of profit or loss.
Okay, so looking at this, I'm going to throw it to the floor. Remember how we explained it, that every group accounting question can be broken down into what happened at acquisition, what happened post-acquisition, and if there is any investment in associate or joint venture, as the case may be. If you look at this question, I take it from the beginning, question 2. They said Cairo is an 80% subsidiary that was acquired 1 year ago. Now look at the next storyline. The next storyline now said that the following information relates to the date of acquisition. You can see, like I told you earlier, a typical group accounting question is a story. It tells you what happens at acquisition. Most times, that's what it will welcome you with. These are the things that happened at acquisition here in this table. When it was done, it now went further to additional information. If you look at additional information 1, the next thing that was now happening was an intra-group transaction where Egypt and Cairo, they were buying and selling between each other. Already, if you look at this first additional information, it is clear that additional information 1 is talking about post-acquisition. If you look at additional information 2, it stated clearly that at the date of acquisition, again, they went back to the date of acquisition, telling us what happened on the date of acquisition before they now finalized on how NCI is valued in additional information 3. It follows the same sequence most times in every question. You just pick up the question. Don't rush, don't argue. Just break that question down into those 3 pieces I've told you about. This question is an introductory question. That's why there is no third aspect of investment in associates. Already, you can see how I've broken it down into the acquisition related stuff and the post-acquisition related issues. Don't forget, when you are dealing with information on the date of acquisition, your goal is to treat goodwill or arrive at gain on a bargain purchase. In the process of arriving at goodwill or gain on a bargain purchase, remember that there are 3 ingredients you will need. Each of those ingredients have the way they affect the preparation of consolidated income statement. Don't forget. Once you are done with treating those things used for calculating goodwill, the next thing you move to is intra-group transaction, which is post-acquisition, before you now share the profit for the year. Let me leave the too much story. I will just project something that shows the income statement, which I'm about to prepare. So the name of the group is Egypt Group. First, I think I like the font called Georgia, font 12. So the name of the group is Egypt Group of Companies. And what we are trying to prepare is consolidated statement of profit or loss and other comprehensive income for the year ended. The year end in that question was not stated. Okay, so we just say for the year ended and we put dash like this. Now, this is your, let me call this sheet CIS, the income statement. The next sheet I'll be showing will be the workings. So I'll create a second sheet for the workings. I'll call these workings. Again, I prefer Georgia and font 12. Now, you can now take a look at the income statement you were given line by line. You will first create like an opened income statement before you move to your workings. So the first thing you do is say revenue. After revenue, please, what's the next line item?
Of sales.
Cost of sales. And I'm sure the next one should be gross profit.
Gross profit.
Yeah, after gross profit, what's the next one?
Operating costs.
Operating costs. Okay. After operating costs, I think finance cost is next. Finance costs. After finance costs, we have profit before tax.
Uh,
Before this profit before tax, I would suggest you leave 1 or 2 lines because you don't know what else you will meet in the question. Maybe you can meet again on a bargain purchase or income from associates. So you leave like 2 lines before you now write your profit before tax. It's advisable to go through that route. The next one after profit before tax is tax itself. Before we now have our profit for the year. And if I'm not mistaken, I'll have to correct this. The requirement is consolidated statement of profit or loss. There is nothing like other comprehensive income there. So I will just remove that reference to other comprehensive income. The figures, are they in millions or in thousands?
yeah.
Millions. Okay. So I will just say Naira millions. After the profit for the year, the next item line that will always come will be what they call profit for the year attributable.
Attributable
Owners of
to owners.
and to NCI.
NCI. Yeah.
So this is the typical format you will start with, right? Now, we move to our workings. The first workings you would stumble on any day, anytime, whether it's income statement, whether it's a statement of financial position, the first thing you must do is to carve out or identify the group structure. This is very important because apart from knowing how the group looks like, it will help you identify whether there is control between parent and subsidiary or investor and investee. Because if there is no control between the investor and the investee, you cannot prepare consolidated financial statement. Control is the sole basis for the preparation of consolidated financial statement. I believe you have learned that already. So the group structure is either you draw your normal lines or you just write it out by saying Egypt in Cairo, then NCI in Cairo. You can just do it this way. And put a percentage sign up here. So according to the question, Egypt in Cairo is 80%, which leaves NCI with the remaining 20%. So that everything altogether will amount to 100%. That's the first thing first. So already you can see that Egypt owns 80%, which is above 50%. That means Egypt controls Cairo. Since Egypt controls Cairo, you can go ahead to carry out the principles relating to consolidated financial statement. But if this is below 50% or 50% on the dot, you might need to check to question whether Egypt controls Cairo. But in this case, it's above 50%. 80% is well above 50%, so there is control. Egypt controls Cairo. The next thing I would advise again to be in your workings is what I refer to as analysis of adjusted line items. So the analysis of adjusted line items will show you at a glance all the adjustments arising from additional information. So all the adjustments arising from additional information, you will see it at a glance from this working tool. And for us to know that there is an adjustment, we will have to be picking the additional information one by one. That's how we handle it. So if somebody is with me, our official reader, please, can you read that additional information one to us?
During the year,
Yeah.
Egypt had sold goods to Cairo
Yeah.
for 100 million naira.
Okay.
These goods were sold at a margin of 40%,
Okay.
and one half remains in inventory at year end.
Good. As you have read the additional information, like I said earlier, every additional information should be pegged to a time frame, whether it's at acquisition or it's post-acquisition. That additional information is clearly a post-acquisition transaction because it's an intra-group transaction. And the type of intra-group transaction is a sale of inventory. So the next thing we ask ourselves, when there is a sale of inventory based on our manual, how do we treat a sale of inventory? Based on our manual, how do we treat a sale of inventory? I will project that manual now. I think I shared it in the last class, but I'll project it right away. So it's projected now. We have identified that that additional information is post-acquisition. So I will just scroll down to the area relating to post-acquisition, which is what I've projected now. What type of post-acquisition transaction is it? It's a sale of inventory. How do I treat sale of inventory? Look at the steps here to treat sale of inventory. Once I do this, I'm home and dry. So the first thing I'm expected to do when there is a sale of inventory is to identify the total sales value of the inventory. So my people, what is the total sales value of the inventory in this question? What is the total amount of sales?
100 million.
100 million. After we have identified it, that is 100 million. What is the next thing we are supposed to do? That 100 million, deduct it from the sales value, that's from consolidated revenue, and also deduct it from cost of sales. That's the second step. Remember, the principle under intra-group transaction is that you should eliminate any income or expense earned within the group. So that sales would have been recorded as a revenue by one person and would have been recorded as cost by another person. So that sales must be removed from consolidated revenue and also removed from cost of sales. That is step 2. So I will just project the Excel document again to show you how that will be done. So the first item we are adjusting is revenue. The second item is cost of sales, because those two items will need adjustment based on what we have learned or what we have picked out from our manual. So we say Egypt. How much is Egypt's revenue?
5,000.
5,000. How much is Cairo's revenue?
2,000.
2,000. How much is Egypt's cost of sales?
Sorry, sir, there's a mistake.
Okay.
That's for the cost of sales. Revenue is 200.
There's a mistake.
That's for cost of sales.
Okay. Revenue is for Egypt is how much?
For Egypt is, sorry, hold on. Oh,
For Egypt is 9,000.
Yeah, Egypt is 9,000. Right?
Cairo is 4,000.
yes.
Yeah,
Cairo
Cairo
is
is
4,000.
All right.
4,000.
Okay. So these are the, for Egypt, these are the information. So the next thing we're supposed to do, remember, that 100 million has been earned within the group. So we'll say intra-group sale of inventory. Step 1, that 100 million, remove it from revenue and remove it from cost of sales. So that's why you see that I have put it in. Let me just copy this formatting here. I hope this is clear. That's step one. Step one, the sales value, remove it from revenue, remove it from cost of sales. Step two is to calculate unrealized profit. And that will take us to working three. So I will just create working three here and term it unrealized profit. Unrealized profit is, the starting point is to ask, what is the unsold inventory? When you identify the unsold inventory, the next thing is to determine the margin. When you determine the margin, the next thing is to now determine the unrealized profit. So I will call this unsold inventory A. I will call this margin B. The unrealized profit will be A times B. So my people, how much of inventory has not been sold according to the question in additional information one?
1/2 remains in inventory.
Okay, 1/2 remains in inventory. So that means 1/2 of 100 million still remains
Yes.
Oh, back there now.
in
Oh,
inventory.
the lawyer by Fulana.
So 1/2 still remains in inventory. 1/2 is as good as 50%. So that is 1/2 times 100 million, which is 50. And the margin according to the question is given on a platter of gold. It is 40%.
Yes.
So that means that unrealized profit will be 50 times 40%, which is 20. So when there is a sale of inventory and you have calculated the unrealized profit, pick this figure and you add it to your cost of sales. By adding it to your cost of sales, you have eliminated that profit. Remember that the higher the cost, the lower your profit. So when there's a sales of inventory, these are the two things you are expected to do. Number one, knock off sales value. Number two, add unrealized profit to cost of sales. When you have done these two things, you are done with treating a sale of inventory. And that marks the end of that additional information. My people, question before we move to the next additional information. My people, question. 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 Okay. No question. Our official reader, what is the next additional information?
Question.
Okay, sir.
Yes, please go ahead with your question.
Question.
Yeah, go ahead.
If it is instead of margin, if it is markup, how are we going to treat it?
Don't worry, we are picking it small. We'll get to the question where we'll see markup.
Okay, sir.
Yeah.
Okay,
yeah.
number 2.
Yeah.
At the date of acquisition, the fair value of Caro's net assets were equal to their book values.
Okay.
With the exception of an item of plant.
Okay.
Had a remaining useful life of 5 years.
Okay. That's all right.
That's all.
Good.
Yes, sir.
This story, that particular side of the story now takes us back to our acquisition. Remember that when we are dealing with our acquisition, the goal is to arrive at goodwill. And before you arrive at goodwill, 3 ingredients must be cooked together. Of those 3 ingredients, which of them does this additional information speak to? The question is for the class. Let me project the 3 ingredients. Of those 3 ingredients used for calculating goodwill, which of them is this additional information related to? My people, the question is for you. Look at it. These are the 3 ingredients used for calculating goodwill. So you read that additional information. Of those 3 ingredients, which one of them does this additional information speak to? Ladies and gentlemen, I'm waiting for you. So which of these three components of goodwill does that additional information relate to? You can read it again, my sister.
Fair value of subsidiaries net asset.
Exactly. Fair value of subsidiaries net assets. And once anything affects this third ingredient, simple. If the fair value adjustment is at acquisition, there is no impact on income statement. However, this yellow part, the extra depreciation, will affect the income statement. So if you look at that question, it's typical. This is how you see it in more questions as we progress. They said that there's an item of PPE. They now said that that item of PPE has a useful life of 5 years. They said that the carrying amount and the fair value are the same with the exception of that item of PPE. But they did not give us the value. So we have to determine the fair value adjustment by ourselves. When we determine the fair value adjustment, we'll now divide it by 5 years. So that will take us to working 4. Working 4 is, let's call it net assets of Cairo at acquisition. So my people, what is the net asset of Cairo at acquisition? How much is ordinary share capital?
300 million.
300. How much is reserves?
500.
500. So these two together gives you the carrying amount. And the carrying amount is 800.
800.
How much is the fair value of the net asset? According to the question.
1 million.
1,000.
1,000, sorry.
All right. So that means the fair value adjustment, that is the balancing figure,
It's 200.
will be 200. That is 1,000 minus 800. Now, this fair value adjustment, is it an
Sorry, sir, Mr. Israel, please, can you recap on this?
All right. Okay. If you read through the question said that on the date of acquisition, the carrying amount of net assets is the same as the fair value, but with an exception of an item of plant. So there's an item of plant that makes it different. If that's the case, what is now the value of that item of plant? That's the next thing, because they did not give us the value. So we have to calculate it by ourselves. And if you want to calculate the carrying amount of net assets, which you would have learned under SFP, you have to add the share capital with the reserves. By the time you add them together, maybe there's retained earnings or as the case may be, you will get the carrying amount. The difference between the carrying amount and the fair value will give rise to a fair value adjustment. That difference is the one attributable to the plant. So this is the value of that plant that additional information 2 is talking about. Based on what we can see from here, this is an upward fair value adjustment. Because it's an upward fair value adjustment, the way it will affect income statement is that it will create extra depreciation. If it was a downward fair value adjustment, it would have created a reduction in depreciation. So since it's upward, the extra depreciation would be added to administrative expenses, or let's call it operating costs. So we can say extra depreciation. Extra depreciation is 200 as derived from working for divided by 5 years. Please, how much would that give us? People, how much would that give us?
40.
40.
40.
All right.
40.
So that is 200 divided by 5. That is 40. So when you are dealing with that additional information, the only thing that will usually affect your income statement is that extra depreciation. The 200 fair value adjustment itself is a balance sheet item. It will not come into the income statement. So that is why I've only picked the extra depreciation as the item that is having effect in whatever I'm doing. Madam Ekemezie, please go ahead with your question.
I was not following. I just stepped out and came in again. Please, sir, I would like to know how you got the 200 because I'm trying to.
Okay. Do you have the question there in front of you?
Yes, I have the question, sir.
Okay. If you recall, when you want to get when they give you that type of additional information, there are two things you are expected to fish out. One, fair value adjustment. Two, the depreciation effect of the fair value adjustment. Those are the two things you always target with that additional information. And from history, you would have noticed that that additional information is very common with almost all group accounting questions. You usually see it. But when you stumble on that type of additional information, fish out two things. One, fair value adjustment. Two, the extra depreciation or the reduction in depreciation. So the first thing is the fair value adjustment. They didn't give us the fair value adjustment in the question, so we have to calculate it by ourselves. To get the fair value adjustment is the difference between fair value of the net asset and carrying amount of the net asset. According to that question, the fair value of the net asset is 1,000.
1,000. Yes.
And the carrying amount is 800. That is ordinary share capital plus reserves. If you add,
that's how you got the carrying amount.
Yeah, that's how I got the carrying amount, which is 800.
Because I was wondering where you got the 800 from.
Yeah, so it's just 300 plus 500. So these fair value adjustments will typically be balancing figure. That's the difference between this 800 and this 1,000.
And 1,000.
That's 200.
Okay.
200. I now said that this 200 as a figure is a balance sheet item because it relates to an item of plant. So that 200 as a figure does not affect income statement. What will affect income statement as far as a plant is concerned is the depreciation of that plant. So we now came up here to our additional information too. We calculated the depreciation, divided that 200 by 5, and we added that 40 to operating cost.
Okay.
So you see, those are the two things. When you see that additional information, regardless of how plenty it is, fish out those two things. Fair value adjustment, extra depreciation. If you can fish out those two things, you are home and dry. These are additional information you will always see in almost all group accounting questions. All right.
Okay, sir. Thank you.
So let's look at additional information. Okay, two more people have raised their hands. Nathaniel, please go ahead.
Yeah, sorry, why was unrealized profit added to the cost of sales?
Good. Remember in our last class, we said that when there is an intra-group transaction, one person would have earned an income and earned a profit, as the case may be, and another person would have incurred expenses.
Yeah.
So it is our job to eliminate any income or expense within the group. Number one of such income is this 100 million, which we have eliminated from revenue and we have eliminated from cost of sales. There is also an unrealized profit, which I explained last week, that the unrealized profit is embedded in closing stock. And closing stock is used to get cost of sales. Because of that, the cost of sales is now lower than it's supposed to be, which means that profit would have been higher than it's supposed to be. So to eliminate that profit, we have to add it to cost of sales, so that once we add it to cost of sales, the gross profit will reduce. As such, we have eliminated that profit like that. So that's the essence of adding unrealized profits to cost of sales, so that we can increase the cost of sales and reduce the profit. I hope that's clear.
Yes, sir.
All right, thank you. The next additional information 3.
Goodwill is to be calculated using the fair value of non-controlling interest at the date of acquisition. An impairment review at the year end reveals that 1/10 of the goodwill that arose on acquisition was impaired during the year.
Okay. Again, if we look at our manual, let me project it again. That little drawing I did. This, if we look at it, that additional information relates to impairment loss. And when we have an impairment loss, look at the two things that we explained that we will do. 1, add the impairment loss to administrative expense or any line item stated in the question. 2, share, for the purpose of sharing profit or loss, deduct the impairment loss. So we start with the first one. We have to add the impairment loss to operating cost. There is no administrative expense in this question. But before we even add the impairment loss, we have to first determine the value of the impairment loss, because the question did not give us. If that is the case, we need to calculate it by ourselves.
Hello, sir, please, I have a question.
Please go ahead.
You are saying we can add impairment loss to the operating expenses.
Yeah.
Can we add it to cost of sales?
You can.
Okay.
Yeah. Sometimes the question will stipulate the particular line item that should be added to. Sometimes when the question is silent, you can add it to administrative expenses if there's administrative expenses. You can add it to operating costs if there's operating costs. And you may add it to cost of sales. I am adding it to operating costs or administrative expenses because it's closer to what we see in practice. In practice, when there's an impairment loss, you will usually see it under the administrative expenses. You hardly see them put it under cost of sales. But my message to you is that the most important thing is that you must add it to a particular expense line. That's the most important thing. Regardless of what you do, it must be deducted in your profit or loss account. I hope that's clear.
Yes, thank you.
Yeah. So the goodwill, the ingredients for calculating goodwill has not changed. There are 3. 1, fair value of consideration transferred. 2, value of NCI. 3, fair value of net assets at acquisition. These are the 3 ingredients for calculating goodwill. The first ingredient, what is the fair value of consideration transferred according to the question, my people?
2,000.
2,000. What is the value of NCI according to the question?
250.
250. What is the net asset of the subsidiary, the fair value of net assets at acquisition according to the question?
1,000.
1,000. So that is minus 1,000. Our 3 ingredients are complete. So from here, we can calculate our goodwill at acquisition.
1,250.
That's 1,000.
Oh, sorry, 1,750. Sorry,
I think it's 1,250. You are correct.
1,750. Okay, is
No,
it?
1,000.
Oh.
You are
Correct.
correct.
Okay, yes. I'm confused. Oh,
You are
okay.
correct. So the next thing, remember that this goodwill as a figure, it doesn't affect income statement. Goodwill is an asset, it's a balance sheet something. What will affect income statement is any impairment loss thereof. And the question has said that there's an impairment loss at 10%.
110.
Yeah.
10%. Yeah.
So that means
That's
1,250
250.
times 10%.
125.
That's 125. So that is 10% times 1,250, which is 125. Me, I don't need to calculate a goodwill at reporting. I don't need it. What I need is this 125. Because if I go and if I say goodwill at reporting now, let me write it. Goodwill at reporting. Goodwill at reporting will be 1,250 minus
1,250 minus
125. This
Yes.
figure, my people, I don't need it in preparing income statement. This is the figure that I need. So if I know what I'm doing, I will not even waste my time using calculator to get this 1,125 again because I don't need it. So what I need is 125 and I've gotten it, except I'm preparing balance sheet. That's the only time that this 1,125 will come in handy. So in this case, this 125 is my business. So I can take this 125, come to my working tool. I'll say impairment loss, which I have calculated in working 5. And I can add it to cost of sales, I can add it to operating cost, but I'll prefer to add it to operating cost because it's closer to what I know in practice. So my people, once you have done this, you have finished dealing with impairment loss. There's nothing else again to do again as far as impairment loss is concerned. Is there any other additional information in the question?
No, sir.
No. So in the absence of additional information, you check again, is there investment in associates in the question?
Mr.
No.
Israel, please, I want to ask a question.
Please go ahead with your question. Shoot.
So I wanted to ask, that unrealized profit,
Yeah.
I wanted to ask, is it for an opening inventory or a closing inventory?
It's for closing inventory. That's the unsold inventory. The question will say stated that a particular portion of the inventory has not yet been sold. Can you quickly check additional information 1 and read it so that you will be on the same page?
Yeah, okay, I've seen it. I wanted to be sure.
Yeah, it's closing.
Okay, sir.
Yeah, thank you. So if that's the case, we have finished dealing with all the additional information. In the question, there is no investment in associates. The last thing you will do is to share the profit for the year. So that will take us to working 6, which we'll call apportionment of profit for the year. That's subsidiaries profit for the year. Apportionment of subsidiaries profit for the year to NCI. Or we can just say share of Kairos profit, NCI share of Kairos profit for the year. Let me put it that way. NCI's share of Kairos profit for the year. So according to the question, what is Kairos profit for the year? How much is Kairos profit for the year in the question?
200.
200.
Yes.
Don't give me poisonous figure. 200.
It's 200, it's correct.
Good. Based on our format, which I will project again, this profit for the year will be adjusted using certain items. And those items will be derived from working 2 here. Remember I told you that this working 2, let me, if I've not said it before, this working two is the brain box of everything you are doing, because it will contain all the adjustments that you have done in that question. And if you look at it, look at all the adjustments here. Now, there are some adjustments here that relate to only the subsidiary, and there are some adjustments here that relate to items that should be shared between parent and NCI. But regardless, I've given you guys a format to identify those items that will be used to adjust this profit. Let me project that format again to refresh your memory. So to refresh your memory, these are the items that we will need. Look at them. That we will need to adjust the subsidiary's profit for the year. This format is what we will apply in that workings now. It's usually most times the last thing you will do before you prepare your consolidated income statement. So the first line is the subsidiary's profit for the year. The second line is any extra depreciation or reduction in depreciation. The next line is impairment loss on full goodwill. The next one is unrealized profit if the subsidiary is the seller, and any other gain or loss that ought to be shared between parent and NCI. You will see that in all of them, I made reference to working two, because I know that all these figures would have been used in working two. There's no way they will not have been used in working two. So if that is the case, I can just get them directly from working two. So be conversant with this format and be conversant with the principle that drives it. So I will project our Excel document back again. So we have Kairos profit for the year. The next thing we need to adjust it for, we say adjustment. Extra depreciation or a reduction in depreciation, depending on what we have done in working two. We can pick that from working two. Impairment loss on full goodwill. An unrealized profit. Only if subsidiary is the seller. Only if sub is the seller. So we'll pick it one by one. First, how much is the extra depreciation according to working two? So I will just move up to working two.
40.
So according to working two, the extra depreciation is 40. So we'll just come here, we'll say minus 40. Because it's extra depreciation, that's why it is coming as minus. Depreciation is typically a cost. Impairment loss, we first must check, is the goodwill full goodwill or partial goodwill? Please confirm from the question.
Full goodwill.
Full goodwill. Therefore, any impairment loss must be deducted as well. So the impairment loss was 125. The next one is unrealized profits. In the question, who was the seller of the inventory? Was it the parent or the subsidiary?
The parent.
The parent. Since the parent is the seller, we will not adjust for that unrealized profit. We will only adjust for that unrealized profit in this working if the subsidiary was the seller. Mr. Tunde, you have your hands raised up. Please go ahead. You have the floor.
Yes.
Yep.
Sorry, how did you know that this goodwill here is full goodwill, sir?
Yeah, check the question. Additional information last. The last additional information.
Okay.
Yeah, check it. You can read it for us so that we can hear you. Are you there? Okay. So the adjusted profit for the year will be 200 minus 40 minus 125. Because I'm using Excel, it's much more easier. I won't wait for anybody to
35.
poisonous figure. That's 35. And remember that NCI is at 20%. So NCI will be at 20% times 35. So that is this times 20%, which is 7. So ladies and gentlemen, once you have done this, that question, there's nothing in that question again. Once you have finished this additional information, this last working, so we can now total all our workings and prepare our income statement. So we can have total for working 2. Please, how much is the operating cost for Egypt?
2,000.
2,000. What of for Cairo?
1,698.
1,000?
698.
698. So the total revenue, I will just add this up. That will give me 12,900. The total cost of sales as well, I will add up to operating cost. So if I will check through my additional information to see whether I've added all I need to add up. I've done that, so I'm fine. I can go straight to preparing my consolidated income statement now. So I move to this sheet. The first line item here is revenue. I've already derived the revenue from working 2. And the figure for revenue is 12,900 based on working 2. Cost of sales too, I've already derived it in working 2. The value for cost of sales, let me go and check it. Cost of sales is 6,920. Because it's a cost, I have to make it negative. It should be in jacket. So my gross profit is just the addition of these two. So operating costs too, I have already solved for it in working 2. I will go again to my working 2 to go and pick my figure jejely, which is 3863. My finance cost, it was not adjusted at all. So I can't find it in working 2. It's only items that are adjusted that I can find in working 2. So for finance cost now, how much is the parent finance cost?
500.
500.
100. How much is the subsidiaries?
2.
2.
2. All right. So 500 plus 2 is 502. So after that, I think it's profit before tax. So already in the question, there was no gain on a bargain purchase. There was no investment in associates. So that would take us directly to profit before tax, which will be an addition of these 3.
The operating cost should be in brackets.
Okay, yeah, thanks. So the profit before tax will just be addition of these 3. So how much is the tax for parent?
700.
700. Subsidiary income?
100.
100.
100. So together it is 800. Then the profit for the year is 815. So profit for the year attributable, the total profit for the year is supposed to be 815. So the profit for the year attributable to owners of parent and to NCI. Remember that we have calculated NCI's profit for the year under working 6. That's the essence of that last working. And the figure we calculated, let me just go back to working 6. We calculated 7 as NCI's share of profit for the year. So it is this same 7 that I will just pick up. And land here. I don't want to link it. I just want to write it out. And this parent will be a balancing figure. Remember that this profit for the year is 815. So the balancing figure would be 815 minus 7, which will give us 808. And that is the end of the question. Ladies and gentlemen, please, question before we look at the second question. My people, please ask me questions. People, question.
Okay, sir. I just want to confirm, since in this question, it was the subsidiary that sold. Or is it not? It was the sorry.
Was the parents that sold?
Okay, it was parents that sold that transferred people. So let me again. I'll come back.
Go ahead now.
I'm confused.
It was the parents that
So
sold.
Okay.
Go ahead with your question.
I will check again, sir. Sorry.
No problem. All right, it's fine then. So any other question, people? Any other question? Okay. Since there is no question, we'll use the next few minutes again. Almost the same approach. You will see again the questions, they are usually similar. Group accounting question, they are usually similar with one another. It's almost mechanical, one way. It's the type of one way that you pass, and LASMA will know what you once you understand the principle. So our official reader, please help us read question 3.
Okay. Maiduguri is an 80% subsidiary of Bonu that was acquired 2 years ago. During the year, Maiduguri has sold goods to Bonu for 750 million. These goods were sold at a markup of 50%. At the year end, 1/5 of these goods remain unsold by Bonu. An impairment review was conducted at the year end. This revealed that no goodwill was impaired during the year. On acquisition of Maiduguri, a fair value adjustment of 50 million was made to the plant of Maiduguri. The plant had a remaining useful life of 5 years and is depreciated on a straight line basis down to a new residual value. The fair value adjustment had not been incorporated into the accounting records of the subsidiary. Number 4, at acquisition, Bonu advanced Maiduguri a loan of 500 million and charged this subsidiary an effective interest loan of 10%. Both companies have correctly accounted for the transactions. Required, prepare consolidated statement of profit or loss and other comprehensive income.
Yeah. Thank you very much. If you look at this one again, it is identical to what we did earlier. Only a few differences. I'm even saying that this one is easier than the one we did earlier. And that is how this consolidated income statement of group accounting works. Those things we have done earlier, you see that we'll do them again. And that's how we'll keep doing them. In most questions you stumble on, there is a way it works. Once you understand it, you are home and dry. Again, If you look at this additional information 1, it's a sale of inventory. When there's a sale of inventory, 2 things you are expected to do. First, identify the sales value. That sales value, remove it from revenue, remove it from cost of sales. The next thing, calculate unrealized profit. That unrealized profit, add it to cost of sales. When you do those things, this additional information 1 is down, finished. Additional information 2 is simply telling us that there is no impairment loss, unlike the question we solved earlier when we had impairment loss. This looks even more simpler. 3, additional information 3 is simply talking about fair value adjustment and extra depreciation, which is similar to what we have done in question 1. 4, it is this fourth one that is different, that is new. This fourth one is an intra-group transaction, but it's intra-group transaction that is referred to as intra-group borrowing. It in itself is also very straightforward, very simple. When there is an intra-group borrowing, one person is the borrower, Onigbese, that's the borrower. The other person is the lender. The borrower will incur interest expense, but the lender will earn interest income. So simple, the interest income and the interest expense must be eliminated, just as every other income and expense within the group. It's as simple as that. So we'll start picking them one by one again. Based on what we have learned before and what is in our manual, we'll treat each additional information one by one. So I will open our Excel document that we have been using, which will be shared after this class, of course. So this first one is Egypt. The next one we'll be looking into is Bono. And this time it is consolidated statement of profit or loss and other comprehensive income. Remember the first case was just consolidated profit or loss, but this one is consolidated statement of profit or loss and other comprehensive income. It takes it one step further. Again, like Georgia. So I will say Bono Group of Companies, consolidated statement of profit or loss and other comprehensive income for the year ended. The year ended was not stated in the question. We are still scratching the surface. All these questions, although they are exam standard, but you will still see more detailed questions as we step further. As we move further, the more detailed the question. If I'm not wrong, the level of rounding is also in millions again. So the first line is revenue. The next line is cost of sales. Then we have our gross profit. Please, after gross profit, what is the next line?
Operating costs.
Operating costs. Afterwards?
Operating profits.
Operating profits. Afterwards?
Investment income.
Investment income. Now, after operating costs, what we have is a finance cost, to my sister. Oh, no. I'm looking at question 4.
Investment income before finance cost.
Okay. So we have investment income. Next thing is finance costs. Then after finance costs.
Profit before tax.
Okay, we leave our typical 2 lines in case of a share of income from associates, even though in this question there is no associate. Or if we have a gain on a bargain purchase, we just leave those 2 lines. We don't know what we'll stumble on in the question. So I leave 2 lines and I say profit before tax. And the next one is tax.
Tax.
We have
Profit for the year.
Then after profit for the year, we have other comprehensive income.
Other comprehensive income.
What is under that other comprehensive income?
Valuation gain.
Revaluation gain. Before we now have total comprehensive income. Of course, at the end of the day, we now have a profit for the year attributable to owners of parent. Profit for the year attributable to first owners of parent and then CI. Remember that this one is always a balancing figure. Then apart from profit for the year, this time we also have total comprehensive income. So the second one we'll be sharing is total comprehensive income. For the year attributable to owners of parent and NCI as well. So this is like a layout set down already.
Hi, so is it owners of parents or owners of subsidiary?
Yeah, it's owners of parent.
Mm.
Yeah, you know that what you are merging together is parent and subsidiaries figure.
Okay.
So even if the subsidiary is going to declare anything to the parent, even if the subsidiary is going to give anything to the parent, it is the owners of the parent that will enjoy it.
Yes.
And the owners of the parent are also the owners of the subsidiary.
Yes.
Yeah. So most times, because in the very first instance, the group, you see that the group is the parent's name that is here. That's Bono, who is the parent. So that's why at the bottom you'll find it that they will say owners of parent instead of saying owners of subsidiary.
Okay.
Yep. So since we have put out this layout, the next thing is workings. Okay, so I will say Bono workings. So the group structure now, parent is Bono in Maiduguri. Please, how much is the percentage?
80-20.
80-20.
80-20. Maiduguri. Today is 18. Today is 20. Everything together must be 100. It's not 100. Something is wrong somewhere. As usual, our working tool still remains the same. Analysis of adjusted line items. Remember that this is driven by whatever you adjust following the additional information. Now, for us to go ahead further, my people, please, somebody should read additional information for us so that we'll know the item to adjust.
During the year,
Yep.
Maiduguri had sold goods to Borno for 750 million.
Okay.
These goods were sold at a markup of 50%.
Okay.
At the year end, 1/5 of these goods remain unsold by Borno.
All right. This again is sale of inventory. We have seen it before. When there is a sale of inventory, remember, step one, adjust your revenue and adjust your cost of sales. So the first items that will be affected, the first two items that will be affected is revenue and cost of sales. People, how much is Bono's revenue?
5,000.
25,000.
5,000.
5,000.
5,000. How much is Bono's cost of sales?
2,000.
2,000. How much is Madiguru's revenue?
1,000.
1,000.
1,000. How much is Madiguru's cost of sales?
200.
200.
200.
Remember the first thing, when there's sale of inventory, knock out the sales value, intra-group sales of inventory. So what is the sales value in this our question?
$750.
750. Sales value is 750. So I want to throw it. How do we handle that 750? Let me throw it to somebody in the class. What do we do with that 750?
We need to look for the cost of the goods, because since it was sold at it seems the profit is inside the 750 million, so we have to separate the profit from the cost.
Okay, that is the second thing we do. The second thing is unrealized profit. But there is a first thing we must do.
You remove it from your cost of sales, and also remove it from your revenue.
Fantastic. So remove that 750 from revenue, remove that 750 from cost of sales. Remember that it's consolidated. Any income and expenses incurred or earned within the group must first be eliminated.
Yeah.
The next thing is to now calculate our unrealized profit, and that will take us to working 3. Unrealized profit. Remember, calculating unrealized profit is another simple thing. You start with unsold inventory, you calculate your margin, and you get your unrealized profit. Assuming unsold inventory is A, margin is B, and unrealized profit is A times B. Very simple. According to that question, how much is the unsold inventory?
1/5 of
1/5.
these goods remained unsold.
All right. So 1/5, that is 1/5 times 750. So 1/5 remain unsold. So I'll say 1/5 times 750. So the unsold inventory is 150. Because this 150 is our sales value, what we must apply is margin. According to the question, what is the margin?
They gave us markup.
Oh, they gave us markup. How much is the markup?
50%.
50%. So when you are giving markup, you have to first convert it to margin before you can do anything.
Margin.
So to convert it to margin, you will say 50 divided by 100 plus 50. That's 50 divided by 100 plus 50. Then the next thing is to calculate unrealized profit, which is 150 times 'So how did we get the unrealized profit? A times B. So this 50, we then pick it like we have done all along, and we add it to our cost of sales. And we are done with additional information 1. Don't forget, when there is sale of inventory, there are just 2 things you need to do. 1, knock off the sales value from revenue and cost of sales. 2, add the unrealized profit to cost of sales. Stephanie, that marks the end of the effort. Let's move to additional information 2. What does it say?
Okay. An impairment review was conducted at the year end.
Yeah.
This revealed that no goodwill was impaired during the year.
Okay. So that one doesn't affect anything. There is no impairment loss.
Yes.
We move to additional information 3.
On acquisition of Maiduguri, a fair value adjustment of 50 million was made to the plant of Maiduguri. The plant had a remaining useful life of 5 years, and it is depreciated on a straight line basis down to a new residual value. The fair value adjustment had not been incorporated into the accounting records of the subsidiary.
Good. Remember that when you see this additional information, what you are after is extra depreciation. Remember, that fair value adjustment that they give you, it is not an income statement item, it is a balance sheet item. So when a fair value adjustment is arising on the date of acquisition, it's balance sheet stuff. So that amount, that fair value adjustment of 50 million in the question as a value has no impact on income statement. However, it will have impact through depreciation. Now, the question did not say whether it's an upward or a downward fair value adjustment. I don't know if it stated so.
No.
No. So what we'll do is that since the question is silent, I want us to assume a downward fair value adjustment so that we can see how to handle the depreciation arising from a downward fair value adjustment. Remember that the first question was depreciation from upward fair value adjustment. So I will just put it down there. Reduction in depreciation. Remember that we are assuming a downward fair value adjustment of 50 million. So when such item, it will be 50 divided by 5. You can see that they acquired that subsidiary, I think 2 years ago. Don't go and multiply it by 2. Remember that your income statement is prepared for 1 year, So the depreciation you will bring here is only for that year. So what we'll now do is to say 50 million divided by 5 years. Similar to what we have done before. 50 million divided by 5 years. That's 50 million divided by 5, and that is 10. So that, since it's a reduction in depreciation, this value will come as a negative figure. Let's say it was extra depreciation, it would have come in as an additional cost to cost of sales. But because it's a reduction in depreciation, so this 10 will be in brackets. Okay, what is the next additional information?
At acquisition,
yeah,
Bonu had Maiduguri a loan of 500 million,
okay,
and charged its subsidiary an effective interest of 10%.
Okay.
Both companies are correctly accounted for the transaction.
Okay. Look at this loan. This loan is between the parent and the subsidiary. This loan is not between the parent and the former owners of the subsidiary. We clarified this thing last week. The loan is between the parent and the subsidiary. The loan is not between the parent and the former owners. Very important. So because it is between the parent and the subsidiary, any impact must be cancelled out as well. So what we will first do in such an instance is to calculate the intra-group interest. Remember that one person will recognize it as an expense, while another person will recognize it as an income. But we first have to calculate that interest. Yes, I can see people raising up their hand. Please hold on. Let us deal with this additional information. So how much was the loan? The loan value was 50 million. And the interest was
500 million.
okay, 500 million, and the interest was 10%.
10%.
So we can just say 50 times 500 times 10. So which will give us 50. That's times 10%. So the two items that will be affected for an intra-group loan will be, if we look here, we have finance cost and we have investment income.
Investment, yeah.
So it is an income to somebody, but it's a cost to another person. It will be deducted from finance costs, so we call it intra-group interest. It will be deducted from finance costs minus 50 from finance investment income, and that is the end. It's as simple as that.
But how about our over depreciation, downward depreciation?
Yeah. Look at it.
Are we not supposed to add this up? Are we not? Okay.
We have deducted it from cost of sales. Yeah.
Okay. Because the other time you added it to operating income. That's operating
cost.
That was what I was asking.
Okay. Yeah. You have the opinion that we should also adjust it through operating costs. That's fine. I agree. I will just create that space. I agree. I'm looking at the time, so I'm kind of rushing. So I will just adjust it from the operating cost like you have suggested. So remember, once you have finished dealing with your additional information, the last thing you will do is to share the profit for the year. Give NCI a share. Now, let me look at those people asking questions. Salami.
Yes, I just wanted to ask because from the additional note for number 3,
yep,
there's no. How do we know there is a reduction in depreciation? Like,
yeah, the question was silent whether it was upward or downward. If you read through that question, the question did not say whether it's upward. It did not say whether it was downward. So we assumed downward so that we can see how to treat it if it is a downward fair value adjustment. Remember that the first question we did was upward fair value adjustment.
So is it when it is downward, there is a reduction in depreciation?
Yes, when it is downward fair value adjustment, to be a reduction in depreciation. When it is upward fair value adjustment, to be additional depreciation.
Oh, okay.
So because the question was silent, I'm with you, go ahead.
Sorry, sir. Can we also say deficit?
Yeah, some textbooks actually use deficit.
Okay.
Yeah.
So if it was in additional depreciation, add the 10 back.
Yeah, exactly. To operating costs or administrative expenses.
Okay. Sorry, Mr. Israel.
Yeah.
Please, the intergroup interest.
Okay.
Why are we treating this twice? Like the 50-50 that we got, that's the 10% on 500.
Good.
Why is it under investment income and distribution?
Thank you very much. You know that when there's intra-group loan, one person is the borrower, while the other person is the lender.
Yes.
The person that is the borrower will have recognized that intra-group interest as finance cost.
Okay, sir.
And the other person would have recognized it as investment income.
Okay.
And you remember the principle, any income and any cost within the group must be removed, eliminated.
Knocked out.
So that is why we are removing this 50 from investment income, and we're also removing the 50 from finance costs. No magic.
Okay, sir.
Yeah.
All right.
Yeah.
Thank you.
Yeah. I believe 2 o'clock is your break, but please let me take some few minutes so that we'll finish this question. So as usual, we start with the subsidiaries profit for the year, and the subsidiaries name this time is Maiduguri. So we have NCI share of profit and total comprehensive income. The first one will be profit, and the second one is total comprehensive income. And the figures are in millions. Ladies and gentlemen, how much is the profit of Maduguri? Profit for the year.
2,300.
550.
What is it? 2,300.
2,000.
2, 3.
Profit for the year
550.
is 2,300.
Okay,
It's
550.
2,300.
No, it's 550. But no, it's
It's
still
550 for Maduguri.
For
Yeah.
the subsidiary.
Oh, man.
Yeah.
Sorry.
You get. So 550. Remember our adjustment, extra depreciation, impairment loss if it's full goodwill, unrealized profit if subsidiary, only if subsidiary is the seller. So we go. All these things, remember you can get them from your working tool. It's the brain box of everything you are doing. So the extra depreciation, this time is not extra depreciation, it's actually a reduction in depreciation. And the reduction in depreciation is 10. A reduction in depreciation will usually increase your profit. So that's why the 10 will be added at this junction. If you remember the first question, we deducted it. But in this question, we are adding it because the reduction in depreciation is like an increase in profit. In this question, there is no impairment loss. So impairment loss will be nil. Again, in this question, who is the seller of this intra-group transaction this time? Is it the parent or the subsidiary? The subsidiary. So since it is the subsidiary, that 50 will be deducted because it is the subsidiary. And remember, we are adjusting subsidiary's profit. So it is the unrealized profit that relates to subsidiary that we should also bring to this place. So that will now give us adjusted figures. So the profit, the adjusted profit for the year will be 510. What is the total comprehensive income in that question for Maduguri?
10.
560.
Total comprehensive income?
560.
560. So all these ones will still remain. So we can calculate NCI share. NCI share is at 20%. So this 510 times 20%, this 520 times 20%, and we are home and dry. So by doing this, that marks the end of this question. Pretty simple, pretty straightforward, and that's how it usually is regularly. So to end everything, we have to add up this our working tool. We sum it up. So we have a last line which we refer to as total. So the total revenue is 5,250. So how much is Bono's operating cost?
1,500.
What is it?
1,500.
1,500.
500.
What of Maduguri?
450.
450. How much is Bono's investment income?
15.
1,500.
1.5. How much is Maduguri's investment income?
350.
350.
350. Maybe, how much is Bono's finance cost?
300.
300.
300.
How much is Maduguri's finance cost?
50.
50.
50. So we are home and dry. We are almost there. Once we do this, we go and populate our income statement now. Revenue is the first thing we can get from working two. I will just go to my working two here, 5250, copy, paste. I don't want to link. Cost of sales too from working two
15.
is 15. Then gross profit will be addition. Operating cost is also in working two. I think
1940.
1940. Because it's a cost, it has to be in jacket. Then operating profit will be addition of the gross profit and operating cost. Investment income is also in working two. That's 1,800. Because it's an income, it's going to be positive. And finance cost is also in working two. It's an adjusted item.
300.
That's 300. So the profit before tax will be operating profit plus finance cost plus investment income. Again, we are still scratching the surface. There was no gain on a bargain purchase. There was no investment in associate. So I'll just remove this. Tax was not adjusted. Please, what is the parent's tax?
400.
Is that
400.
400? How much is the subsidiaries tax?
100.
100.
100.
So that gives us 500. Profit for the year will be 2810. Revaluation gain. How much for the parent?
100.
Subsidiary income.
10.
10.
That is 110. So that means total comprehensive income is this plus this, which is 290. So we have already calculated all these ones before. For example, the profit attributable to NCI. If you look down here and working 5, we have it here. Yeah, the profit attributable to NCI is 102. Is in working 5. The total comprehensive income attributable to NCI is also in working 5.
Balance.
That's 104. So this parent is a balancing figure. But first, what is the profit for the year according to this guy up here? The profit for the year is 2810. Total comprehensive income is 2920. So if we are to calculate a balancing figure for owners will be 2810 minus 102. For the total comprehensive income, it will be 2920 minus 104. Ladies and gentlemen, that is the end of that question. Let me see, I think someone sent the chat. Investment income is given in the question for both entities. Yes, we have adjusted it. Take a look at our working two. So in our working two, investment income for Bono is here, and for Maiduguri is also here. So we have added it before we arrived at this 1,800. I remember that it is this 1,800 that we use here. Ladies and gentlemen, any question before we wrap up the class?
No question.
Okay, so since there's no question, immediately after this,
Okay, question
please
on
go ahead.
depreciation.
Go ahead, go ahead.
Depreciation of this Bono is different from the one we did for Egypt, because from where you said in the question.
Go ahead. I'm listening.
Yes, I want to open my question.
All right.
Okay. Okay. The question on the acquisition of a plant from Maiduguri. So we are giving this right, but here you made a deduction.
Yes.
Instead of an addition.
You know, in the previous question, that was Egypt. It was an upward fair value adjustment. Let me project Egypt so that you see it. Look at Egypt. It was this fair value adjustment of 200 was upward. So
upward.
An upward fair value.
Subsidiary to parents.
No, between carrying amount and fair value. Fair value adjustment is the difference between carrying amount and fair value. Any day, anytime.
Okay.
So in this case, the fair value was higher than the carrying amount. That's what we refer to as upward fair value adjustment.
Okay.
So if it is an upward fair value adjustment, it will create extra depreciation. That's why the depreciation here was an additional depreciation of 40. So upward fair value adjustment will give birth to extra depreciation. However, in Bono's case, we assumed that the fair value adjustment is a downward fair value adjustment. Look at it here. The question was silent, but we assumed there was downward fair value adjustment. So when there is a downward fair value adjustment, it will be reduction in depreciation. That is why it is in jacket. I don't know if that's clear. Yeah, if it's not clear, please, we can always meet after this class and we can run through it together. All right, ladies and gentlemen, my time is fast spent. Thank you very much for listening to me. Ifeanyi, please. Yeah, send your. You said, does it mean when it is not stated, we can assume? Yes, you can assume, but state your assumption and be sure that it is not stated. If it is not stated, you assume and state your assumption. Like I've done.
Mr. Israel,
yeah.
How are we going to get this session of the
this Microsoft Excel document?
Yes.
Yeah, I'm sharing it immediately to the group.
And even for the last one.
Yeah, I'm sharing it. I'm sharing everything immediately to the group. For that last one, I've already shared a PDF document to you. But I will reshare it. I will reshare it. Don't worry. This one and the PDF document, I will reshare it. Thank you very much for listening.
All right.
Once the video is uploaded, it will be shared with you as well.
All right, sir. Thank you.
Thanks.
Okay.
Thank you.
Thank you, sir. Nice day.